Hello, and welcome to today's training on liquidated and delinquent account reporting. Today's agenda, we will go over definitions, year-end reporting requirements, Legislative Fiscal Office or LFO reporting overview and website entry instructions, as well as some LFO reporting scenarios and next steps. Some definitions. First is abated, which is an account that has been determined not to be owed. This can be for a couple of different reasons. One may be that you negotiated an offer in compromise or a settlement for an account where a portion of that account is paid and the remainder is waived. The portion that is waived is considered abated. Another example would be an account that is discharged in bankruptcy. Since the court determined that the debt is no longer owed, it has been abated. Note that these are accounts that have been written off are still fully collectible. Therefore, a write-off is not an abated account. Next, we have account, which is the debt relationship between a state agency and an individual or entity, which may include multiple organizations or time periods. Refer to OM 354010 for more information. Next is adjustments. These are entries to either increase or decrease a debt, and adjustments may be required to correct an administrative error or when the debt is abated. Adjustments do not include write-offs. Delinquent accounts is an account for which the receivable did not receive the payment by the original due date. DOR program codes. The restricted program code are accounts assigned to Department of Revenue for collection using the offset only or the interception of tax refunds. And then an unrestricted program code are accounts assigned to the Department of Revenue for full collection services, which may include letters, phone calls, garnishment, skip tracing, asset locations, as well as offset. Fiscal year is July 1 of one year to June 30th of the next. Fund types. This is important for entry into the LFO website since the data is entered by fund type for the receivables that you have to report. So first is federal funds, which is money that a state agency receives directly from the federal government and or the programs that are administered through those federal dollars that may ultimately create a receivable. Next is general fund, which is money appropriated by the legislature to a state agency or is statutorily designated as general fund. Next is lottery funds, which is money received by an agency from lottery proceeds that is then used in a program which may establish a receivable as part of that program operation. Next is other funds, which is monies received by a state agency from sources other than the general fund, federal fund, or lottery funds. And for purposes of reporting, this also includes accounts receivable related to the reduction of expense, even if that expense was from the general fund. And finally is other funds pass through. This is other funds that are collected by an agency and then ultimately remitted directly to another entity or passed through the agency to another entity. A liquidated account in general is an account where the exact past due amount is known and the debtor has been notified of the debt and given an opportunity to dispute the debt. Refer to OM 353030 for a complete definition. OAM, or the Oregon Accounting Manual, which is the state policies on fiscal matters. And receivables. These are amounts owing to the state, including accounts receivable, loans, notes receivable, and interest. Receivables can be due from private persons, firms, corporations, other agencies, employees, and the federal government. Refer to OAM 650000 for more information. And reversals. Reversals are any account that was previously reported to LFO as liquidated and delinquent that no longer meets the definition of liquidated and delinquent as of June 30th for this reporting year. For example, if the debtor disputes the debt, while it is under review, it is not considered liquidated and delinquent. Next, we'll go over some year-end reporting requirements, including accounts receivable performance measures, the certification of write-off, abated, and canceled debts, the LFO reporting worksheet, which is a recommended tool for agencies to use in the entry to the LFO delinquent reporting system. Next is the agency year-end checklist, and then finally a supplemental report to the Legislative Assembly if your LFO ending balance exceeds $50 million. So accounts receivable performance measures are applicable to agencies subject to the Oregon Accounting Manual, refer to OAM 1.05.00 to see if you are subject to the OAM. Accounts receivable performance measure policy can be found in OAM 356020, and the form to complete the reporting is OAM 753512. For purposes of the ARPMs, the receivable is defined when revenue is not recognized at the point that cash is received. But for purposes of this report, it does not include loans or notes receivable, except for the amount of any periodic payment which became delinquent during the reporting period. So a mortgage payment that was paid after the due date is still reportable even if it was paid before the end of the reporting period. So here is an example for the quarterly tab for collections. And so you see you have total agency collections, L&D collections for each quarter, as well as the targets. Total AR collections includes all collections that were applied to a receivable, regardless of the liquidation or delinquency status at the time of payment. Liquidated and delinquent collections is the subset of the total AR collections that were applied to a liquidated and delinquent debt. And the total for the fiscal year should match the collections reported to LFO. If data from a prior quarter needs to be corrected, make the update in that quarter and then include a note that the prior quarter has been corrected. Be sure to review the agency targets and adjust as needed for the next quarter. Do not change a prior quarter target. The next tab in the ARPMs is the 90 days past due, and this has data for new AR established during each quarter. This includes anything, even if it was paid during the quarter or paid before the due date. This is all receivables created, and you would include the receivable even if it is not yet due. So for example, in quarter 4, an invoice established on June 29th would still be included as new AR established. Next, you have the quantity and dollar value of the total AR outstanding, as well as those that are over 90 days past due. The idea here is to use an aging report and be able to quickly grab this information from your aging report. Value of the new AR established, again, includes all receivables created, whether they were paid or not. And there are entries included in the ARPM for write-offs adjustments, which are not reflected in the AR outstanding. So please use the agency comments to note any such large transactions that may significantly impact the AR outstanding. If data from a prior quarter requires correction, make the update in that quarter and then include a note that that prior quarter has been corrected. Again, please review the data and adjust your targets for the next quarter and do not change prior quarter targets. Next, we have the annual measures, which the first is the days to assign. This is the measurement for the length of time it takes to get accounts assigned to either the Department of Revenue or a private collection firm for agencies not subject to centralization. So OAM 354010 defines the MCAT or Mandatory Collection Agency Transfer eligibility date as the latter of the following dates, either the date that the AR became both liquidated and delinquent or the date that an account exemption expires. This measurement should only reflect the time frame for initial assignments, do not include accounts that were previously assigned, returned, and later reassigned. Be sure to review the data and adjust the targets as needed for the next fiscal year, and do not change the current targets from what was reported last year. The next annual measure is days to collect. This is the total length of time from when an AR was established or its effective date and the date that it became paid in full. Only include receivables that became paid in full. If an account is on a payment plan and has not yet been completed, then don't include it in the performance measure for that fiscal year. For the purposes of this ARPM, the calculation is the date the account became paid in full, less the effective date of the receivable, which is either the date the agency can recognize the revenue, as described in OAM 1535, or the due date of a delinquent loan payment. Be sure to review the data and adjust your targets as needed, and again, do not change the current year targets from what was reported last year. And finally, we have the write-off measure. You'll record the total value of write-offs during the fiscal year. The other information here besides the targets is picked up from other fields in the ARPM, such as the new AR established and the beginning balance. Only include receivables that were determined to be uncollectible by management and have had the appropriate accounting transactions recorded during the fiscal year. Note that the liability for the debt still remains on a write-off account. Do not include amounts that were discharged in bankruptcy, compromised or settled, or canceled under a specific agency authority. The amount of the write-offs in the ARPM should be equal to the amount of entries in SFMA if your agency is subject to using SFMA, and greater than or equal to the amount reported to LFO and in the annual certification. Be sure to review the data and targets, and again, do not change the current year target from what was reported last year. The three remaining tabs in the ARPM worksheet are collection ROI, recovery rate, and turnover rate. These are recommended but not required unless your agency has a DAS exemption from the 90-day assignment, in which case you must complete the collection ROI tab. Once you've completed the ARPM form, it must be mailed to swarm@das.oregon.gov by October 1, 2025, or at the same time that your LFO report is submitted. There is AR performance measure training resources available at the website listed here. The next report is the certification of write-off, abated, and canceled debts. The applicability for this report is any state officer, board, commission, corporation, institution, department, or other state organization having power to collect funds. semi-independent agencies listed in ORS 182-455, as well as the smaller boards and commissions listed here. This report does not apply to the Judicial Department, the Secretary of State, the Treasurer, or the Legislative Branch, or agencies not subject to ORS 293. Here's the top half of the certification form. Include the accounts that were written off during the fiscal year, referred to OAM 355010 for a definition of write-off. Next, you'll include the accounts abated during the fiscal year, refer to the definition section of our presentation. For purposes of certification, abated also includes accounts canceled by agencies other than the Department of Revenue that have statutory authority to cancel a debt. The last box for accounts canceled by the Department of Revenue is only to be used by the Department of Revenue and is related to accounts that are canceled under the specific statute ORS 305.155. Once you've recorded that information, the agency will certify that the transactions are processed in accordance with applicable statutes and rules. The AR accountant would sign. If your agency does not have a designated AR accountant, it would be whoever is doing your year-end AR reporting. And then the chief fiscal officer or director signature would be, can be essentially any supervisor if your agency does not have a designated CFO. But ultimately, the idea is that it has been reviewed and verified that the information is correct for the agency. The completed certification form must be emailed to swarm@das.oregon.gov by October 1, 2025, or at the same time that your LFO report is submitted. Next, we'll go through the LFO reporting worksheet. This is a resource developed to assist agencies to identify some common reporting errors, as well as to aggregate their data in a way that will aid in the entry of the data to the LFO reporting system. Use of this worksheet is not required but highly encouraged. The LFO reporting worksheet contains built-in formulas that will highlight cells in red and show an error if the condition is not true. Once all entries are made, if they are still red, review the condition and look for an entry error. Enter the data by fund type, and the worksheet will automatically calculate an agency total. General funds is for reporting receivables that create revenue in the general fund and should be such as a tax receivable and or otherwise designated to the general fund per statute. For purposes of this reporting, receivables related to general fund reduction of expense established under OAM 20.40 should also be reported as other funds. So the first section of the LFO reporting worksheet, this is designed to be the same entry format as what will go into the LFO reporting website. Includes the beginning balance. For the LFO website, the site will carry forward your balance from last year into the beginning balance for this reporting year. The worksheet, you will need to enter that information to match what is in the LFO website. Next, you'll include additions, collections, accounts closed, which is the count associated with any account that became closed associated with your collections. For write-offs, the accounts closed would also include, besides accounts paid in full, can be an account that is adjusted to zero. Next, you have write-offs, include the count and value of those write-offs. Adjustments is the value, And then the reversals is both the number and value of those accounts. The system or the worksheet will then calculate the ending balance, verify that against your records. This example shows only the general fund, but the worksheet does include columns for all of the different fund types as well as the total. Next is section 3.A. Of the amounts reported in section 2, you will report all liquidated and delinquent account activity for accounts that have been assigned to the DOR unrestricted program codes. So this is the full collections activity. Do not include any accounts in section 3A that were assigned to a restricted program code. You will separately report both the number and value and then the collection fees that were paid by either the debtor or the state agency. Again, this is related to unrestricted accounts only. Note that the forward to PCF is highlighted here. That is no longer used since fiscal year 2020. Any account that is assigned to the Department of Revenue and forwarded to a PCF is still reported in section 3A, regardless of where it is at in the collection life cycle at DOR. Executive branch agencies subject to centralization that have accounts in a recommended for write-off status as of June 30th, but have not completed a write-off entry should not report accounts in the return to originating agency in section 3A. Because the account is still at DOR, it should continue to be reported in the DOR ending inventory until the write-off entry is completed. Next section is section 3B for accounts at a private collection firm. Again, of the amounts reported in section 2, you will report all liquidated and delinquent account activity associated with the accounts assigned to a private collection firm directly by the agency. And again, you'll include both the number and value of collection fees that were paid by either the debtor or the state agency. Again, note that the return to DOR section is no longer used. Section 3C, include L&D accounts that were resolved through an accepted offer in compromise and were paid in full during the reporting fiscal year. The data requested for section 3C should include information regarding the entire life of the account. So the original debt, let's say it was a $1,000 debt originally, and you agreed to settle that debt for $600, and they would then have the $400 remaining amount waived. You would include, even if the payments occurred over multiple years, you would only include the information here if the $600 had been paid during this fiscal year, and you would include the original $1,000 debt. The net settlement received would be the $600, and the variance would then be the difference or the amount that the agency waived. The next portion of section 3C is collections on accounts due to offset. Of the total collections that were reported in section 2, you'll report the number and value of L&D account collections received via offset during the fiscal year from either the Federal Treasury Offset Program, which is a very select number of state agencies that are involved with this federal program. You will include State of Oregon Vendor Offset Program, or agencies other than Department of Revenue. You would only include a value here if it was an intra-agency vendor offset, meaning the agency offset a payment that was owed to a vendor that also owed the agency money. That would be reported here as a vendor offset. If your agency received a garnishment from DOR and responded to that garnishment, that is reported by DOR, not the agency. And finally, the State of Oregon Tax Offset Program should include restricted program collections, which is also in Section 2, as well as the unrestricted program collections from both Sections 2 and 3A. Section 4 of the LFO reporting worksheet is regarding accounts due from current or former employees. Of the ending balance reported in Section 2, you will report the number and value of the liquidated and delinquent accounts due from current or former employees. Accounts and amounts reported should only include those debts related to an employee's job, such as wage or a travel overpayment. Any accounts that are currently assigned to DOR or a PCF should also be reported in Section 3. Or if it is not assigned due to an exemption, it should be reported in Section 5. Section 5 is the accounts exempt from assignment. Of the total liquidated and delinquent accounts reported in the Section 2 ending balance, identify the number and value that qualify for either a statutory or administrative exemption and were not assigned as of June 30th. Do not include accounts that are reported as an account outstanding in either Section 3A or 3B. If you've reported it there, it is not something that you would include as an exemption. Only the accounts that have not been assigned. If an account meets more than one exemption criteria, only report it once in the criteria that you feel most applies to that account. Once you've entered all of that information in the worksheet, you will return to Section 2 and you will evaluate the unassigned and doubtful account balances. You will see that the worksheet calculates the unassigned non-exempt accounts. In the LFO website, you will need to enter that information, so the use of the worksheet will assist in the proper calculation. Next, you will have the total unassigned non-exempt accounts that are no payments for more than 90 days. You'll indicate the number and value of those accounts that have not had a payment for more than 90 days as of June 30th. Note that agencies that report accounts in this section must also include a description of the efforts currently being taken by the agency to collect these accounts that are unassigned in the note field of the LFO website. And then the next field is the doubtful accounts. You will include the number and value of accounts that the agency believes is doubtful to ever be collected. Note that this should be less than or equal to what the agency has reported in the ACFR as an allowance for doubtful accounts. Finally, you'll use the Notes tab to capture the same information that is required to be entered to the LFO website, and should include notes regarding whether the agency is subject to ORS 293.231, yes or no. If no, then include the statutory reference. Next, any significant reporting changes or large data variations from the prior year should be identified and explained in the notes. And finally, if there were unassigned non-exempt accounts with no payments for more than 90 days, the note should indicate both the number and dollar value of accounts that have previously been assigned and returned to the agency. This is for non-centralization agencies. Next, you will include the current efforts being taken to collect on those unassigned accounts. Repeat the entry process for all fund types that had activity or balances. Verify that the total columns match the agency internal records. You'll verify the ending balances by section, reconcile to your internal records, both for DOR activity as well as PCF activity, exempt accounts, etc. Use the worksheet as a source document for entering the data into the LFO reporting system. The next report is the agency year-end checklist. All agencies subject to the LFO reporting requirements must submit a completed checklist to swarm@das.oregon.gov no later than October 1, 2025. Excuse me, this did not get updated, to be eligible for the accounts receivable honor roll. Use the checklist after completing your reporting worksheet and before entering the data to the LFO website. The checklist will help identify if there are any data issues between the different reports that should be corrected before making the LFO entry. Note that the items in the questions are color-coded to reference the report where the data is to be found. Items 1 through 20 in the checklist should be marked yes unless the agency is exempt from completing one of the reports in that specific question, in which case the correct answer would be NA. Any item answered no must include a comment that explains why that is the correct response for your agency. Although typically a no response means there is a problem with one of the data elements in a report. For example, question 5 asks if the ARPM value of the AR accounts outstanding is greater than or equal to the LFO report section 2 ending balance. Since the ARPM is asking for all agency AR outstanding and the LFO is only the liquidated and delinquent subset of accounts, the LFO report cannot be more than the ARPM. Review the questions in items 21 through 23 to ensure the proper notes have been identified for the LFO entry. Verify that the data from each of the respective reports when you are completing the checklist. Next is the supplemental report to the Legislative Assembly. This is applicable to only agencies that report an ending balance of $50 million or more in their LFO report. Agencies must submit this report to the Legislative Assembly by December 31st, answering these 4 questions. Any questions regarding this report should be directed to the agency's LFO analyst. LFO reporting overview. LFO reporting is applicable to the executive branch, judicial branch, semi-independent agencies, public universities, and the small boards and commissions noted here. Agencies are required to report to LFO if any of the following conditions apply. If the agency had no liquidated and delinquent accounts to report, you still must submit a report stating that you had no L&D accounts. If the agency reported an ending balance in the prior fiscal year, since that balance is carried forward to the beginning balance for this year, you must still complete a report even if there was no new activity for the current fiscal year. If the state agency had any accounts that became liquidated and delinquent during the fiscal year, even if the account was collected, assigned, returned, abated, canceled, or written off during the year, and the ending balance is 0. The Swarm Resources website provides links to the LFO reporting website, as well as the LFO reporting manual, which includes a field-by-field definition for all data to be entered to the LFO website. The LFO website entry will go over the process of logging in, the process of reporting for agencies that have nothing to report, process of reporting for agencies with data to report, and we'll discuss some common reporting errors. Logging into the LFO website, you will select your agency from the drop-down menu. You'll enter your agency password and click Log On. If you forgot the agency password, click the Request Password in the lower right corner of the screen. For agencies with nothing to report, this should only be used by agencies that had a zero ending balance and did not have any liquidated and delinquent activity during the fiscal year. After logging on, click the Nothing to Report button. A pop-up screen will appear for you to confirm that you truly have no activity to report. Once you click Confirm, the system will confirm the receipt of your report, of which you can take a screen print for your records before logging off. Agencies with data to report. If the agency had an ending balance greater than zero in the prior fiscal year or had liquidated and delinquent activity during the current fiscal year, you'll enter the data to the appropriate fund type. Refer to the LFO reporting worksheet for the fund types, number, and value of accounts to enter into each section of the LFO report, as well as refer to the reporting manual for additional definitions and instructions for each field. So after you log on to the website, select the fund type drop-down menu, select a fund type from that menu, and then click Create Fund Report. Note, you only need to create a fund report if the agency had liquidated and delinquent accounts for that fund type. If you only have one fund type to report, you only need to complete this process for that one fund type. Don't create a fund type with all zeros in it. That is not necessary. The data entry, this will look very similar to the LFO reporting worksheet. You'll enter the data for each field. Note that the beginning balance will automatically populate from the prior year, and the ending balance will automatically calculate based on your entries. Note, you do need to tab through fields for that calculation to occur. Section 3A, you'll enter the data for each of those sections from the worksheet, as well as Section 3B, 3C, Section 4, and Section 5. Finally, enter the Notes field. Again, the required information is whether the agency is exempt from the assignment provisions of ORS 293, and if no, provide the exempting statute. If you have any significant reporting changes from the prior fiscal year, include a reason for that change, as well as report the value. If you reported a value greater than zero for unassigned non-exempt accounts with no payments for more than 90 days, include the number and value of any accounts previously assigned and returned to the agency, and a description of efforts currently being taken to collect those accounts. Once all of the entries for the applicable fund types are completed, click the Save button. The screen will go to the top of the page and an action confirmation will appear. After initially saving, the edit and print options will then appear. And if there is data to report for additional fund types, click the Home button to return to Section 1 and repeat the process in slides 55 through 63, for each fund type that the agency has accounts to report. Again, it is not necessary to create a fund type with all zeros. Once you've completed all entries, click the Save button, go to the Home button, and click the Finished Reporting button before logging off. Some LFO common reporting errors include ending balance errors. Be sure to tab from field to field, verify that the calculated number matches what you have in the LFO reporting worksheet. If your Section 2 ending balance is less than the sum of Sections 3A, 3B, and Section 5, that is a problem. Sections 3A and 3B are subsets of those accounts that are assigned, as well as the Section 5 is accounts that are exempt. The sum of those parts cannot be greater than the whole, which is reported in Section 2. If the number of accounts field is blank for all fund types, that is an error. You do need to report the count of the liquidated and delinquent accounts as well as the values. If your account balances do not reconcile with the Department of Revenue or private collection firm reports, please verify your data against the reports that you have received from these entities when making your entries. Note that the DAS process will do a comparison, and we're looking for how reasonably close is the information, but we do understand that there are some timing components that may cause slight differences between what DOR or the private collection firm reports and what the agency is including in their LFO submission. If the notes section do not include the required reporting information, that is an error. Also, if the finished reporting button is not clicked, that is an error. Or if the reporting manual instructions are not followed. Next, we'll go over some LFO reporting scenarios. The following slides will go through these sample scenarios. These are meant to be simple examples of typically single accounts or in some cases a couple of accounts, just to show the process of where that information is recorded in the LFO submission. So first is a new L&D account that was also paid during the fiscal year. Since it was a new account, it is reported under the additions field, both the count and value. Since it was paid in full, it is reported as the $500 in collections, as well as the account closed since it was paid in full. Our next scenario is a new assignment to Department of Revenue. Here we have in section 2 a new account for additions that is then assigned, so it is also reported as an addition in section 3A. Department of Revenue completed a collection of $100, so that is reported in both section 2 and 3A. Next, we have the account at Department of Revenue with an RWO status, but no write-off was recorded. Since the account was assigned in a prior year, it is part of the beginning balance. And since DOR identified that it was recommended for write-off, but it was not actually written off by the entry, no further entries are required. It is still reflected as an account outstanding for the end of the fiscal year. Our next scenario is an account at DOR with RWO status that the agency did complete the write-off entry. Once again, you have a beginning balance in sections 2 and 3A. Since DOR identified the account as recommended for write-off, you would use the return to originating agency field to remove that account from section 3A. The write-off entry is completed, so it is recorded in section 2. Next, we have a previous write-off with a current year collection by DOR. So in this case, it had been previously identified as a recommended for write-off. So it has a 0 beginning balance. So you have to reestablish the AR in both sections 2 and 3A. Next, the payment that DOR received is recorded in both sections 2 and 3A. And note that the ending balance is the same between the two sections. Since the account was liquidated and delinquent at the time of the write-off, it is still liquidated and delinquent after being reestablished. PCF activity. In this scenario, we have two accounts that were assigned to a PCF by the agency prior to the fiscal year. So we have a beginning balance in both sections 2 and 3B. The PCF collected $300 on one account, so that is reflected in both sections of the LFO report. Next, we have one account that the PCF returned to the agency that the agency subsequently wrote off. So you have return to originating agency in section 3B and the write-off entry in section 2. Note, do not include activity in section 3B if the assignment was completed by DOR. That is, again, reported in section 3A activity. Our next scenario is an amount due from a current or former employee. You have an addition in section 2. In this case, that account was assigned to the Department of Revenue, so you have an addition in section 3A. DOR collected a partial payment, so the $50 is recorded in both sections 2 and 3A. The ending balance in section 2 matches the ending balance in section 3A and is then reported in section 4 for an amount due from a current or former employee. Our next scenario is an interest accrual. This would apply only if your agency has actually recorded interest during the fiscal year. So in this case, we have a beginning balance of $800. The addition of the amount of the interest for the year is recorded as an addition. Note there is no count because the count was already part of the beginning balance. And in this example, the account was not exempt from assignment, so it was assigned to Department of Revenue during the year for the combined principal and interest amount. So you have one account for $872. Our next scenario is the agency that compromised an account that was paid during the fiscal year. So in this scenario, the original account was originally $4,500 and had accrued interest as of $500 as of June 30th, 2018. Excuse me, this should be 2024. I did not update this for this year. So you have a beginning balance of $5,000 in section 2. The compromise was for the debtor to pay $3,000 and the agency would waive the $1,500 of the original debt and the accumulated interest. So you have the additional interest of $100 for the current year, the collection of $3,000 that the debtor paid. That account is now reported as closed since it is paid in full for the amount of the settlement. The adjustment or the compromise portion of $2,100 is recorded as an adjustment because there is no balance remaining, and that same amount is reported as the variance in section 3C. That is the amount that the agency agreed to compromise. The next scenario is a collection that was due to an offset. So here you have a beginning balance both in sections 2 and 3A for an account that was assigned to Department of Revenue. DOR collected $350 from an offset, which is included in section 3C under the tax offset program, state tax offset program. Our next scenario is an account exempt from assignment. Note, only include accounts that are not assigned to either Department of Revenue or a private collection firm. So here we have an addition in section 2 of $4,000. And in this case, the account is owed from another state agency and therefore is exempt under OS 293231. as a state agency receivable, so you include that in Section 5. And then the total exemptions for the year match your ending balance in this particular scenario. Next, we have an account comprised of multiple fund types. So here you have one $5,000 account, which is comprised of 60% federal funds and 40% other funds. You will report the number of accounts in the fund type that has the largest portion of the balance. So here, the 5,000, 60% is listed as federal funds, with the 40% as other funds. Account is put under the federal funds, which is the higher portion. The same thing applies to collections that were made in the same percentage. Verify that the total of all fund type entries match the agency record. So next steps, what do you need to do? Evaluate your fiscal year end and liquidated and delinquent account activity. Review the reporting manual. Complete the LFO reporting worksheet. This is recommended, not required. Complete the agency ARPM report, if applicable to your agency. Complete the agency certification form, if applicable. Complete the agency checklist to verify data across all reports. Next, you will then enter the data to the LFO reporting system, and then email the following completed reports to swarm@das.oregon.gov for review, with a target date of September 16th to allow time for SWARM to review and any possible corrections that are necessary by the agency before the final deadline of October 1st. Those are your LFO reporting worksheet, if you used it, the quarter 4 and annual ARPM report, if applicable, the agency write-off abated and canceled debt certification form, as well as the agency checklist. And finally, if you're an agency that reported a balance of 50 million or more ending balance to LFO, then you will begin preparing your supplemental report and submit that to the Legislative Assembly by December 31st through the Legislative Fiscal Office. And that concludes our training for today. Thank you very much.